Hello and good morning. Welcome to today's Technology Association of Oregon webinar, M&A Trends and Best Practices, Navigating the New Normal, sponsored by KBF CPAs, and the series is sponsored by Roth Capital. I'm Skip Newberry, President and CEO at TAO, and I'm joined by Justin Martinez, who's TAO's Event and Program Coordinator. He's going to be providing back-end Zoom support. A couple of rules of engagement before we get started. All participants have been muted. Please remain on mute unless a TAO staff member unmutes you and calls on you to talk. You may ask or respond to questions in the chat box publicly or privately by directing your message to me or Justin, who is under the name TAO admin. We'll monitor the chat box throughout and respond to any discussion items that get raised that way. We'll ask you all to engage via the participant icon on your screen. And we also ask that you please engage with us on social media during this call and throughout the day. We love to share what's happening at TAO and to get participant takeaways from our events. Thank you again to KBF CPAs and Roth Capital Partners for their support in developing this program and the overall series. Finally, it's my pleasure to introduce our panelists for this session. Dirkson Charles, founder and CEO of Loar Group. Andrew Rippy, Managing Director, Software and Investment Banking at Truist Securities. And Josh Smith, Partner at Tonkon Torp. Finally, it's my pleasure to introduce our moderator for this conversation, Peter Buss, Partner at KBF CPAs. Take it away, Peter.
All right, thank you, Skip. Welcome to our presentation today. Our topic will be tech industry M&A trends and best practices. As Skip said, my name is Peter Buss. I'm a tax partner at KBF CPAs. I'll be moderating today. Before we begin, just a little bit of background on KBF CPA. KBF is a West Coast CPA firm that offers a full range of tax, test, and advisory services. We serve approximately 200 public companies and hundreds of private equity and venture-backed businesses. We have offices in Seattle, Portland, Irvine, and San Diego with professionals across the US. At KBF, we consider ourselves a boutique public accounting firm. We started our journey almost 16 years ago with the idea of helping public, private equity-owned, and venture-backed businesses navigate the complex world of accounting for income taxes. That service line continues to be our largest practice, and it's the primary driver for all of our other service lines. Over the years, we have built out a number of specialties that allows us to provide a full host of services to our client base. During 2020, we've continued to add accounting professionals to all of our different practice areas, including international tax, sales tax, and employment tax. Skip had listed the panelists today, and I'll let them kind of talk about their background so people have a little bit of context. And maybe we'll start with Dirkson Charles.
Thanks, Peter. Pleasure to be here today. Hope everyone's keeping safe in this interesting environment that we're living in. So my name is Dirkson Charles. I'm the Chief Executive Officer and founder of a company called the Loar Group. Briefly on my background, got my basic training in accounting and finance, but for the better part of the last 3 decades, I have, managed and run aerospace component manufacturing companies. So I've had the opportunity to acquire businesses of all sizes, all different types of disciplines, whether that's in military, space, or commercial, as an example of some of the sectors. And the business Loar Group that I currently run started in 2012 and have done 12 acquisitions underneath that umbrella, looking to do number 13. I'll keep it there for now. I'm sure I'll get the opportunity to talk a little bit more about what we do. Thanks, Peter.
Thank you, Dirkson. Josh Smith.
Yeah, thanks, Peter. As Skip mentioned, I'm Josh Smith. I'm a partner at Tonkon Torp, which is a large local law firm, full service law firm with a very robust M&A practice. Personally, I practice in both the entrepreneurial services and M&A practice groups. I really enjoy that because I get to take companies from inception all the way through their various stages of funding and financings, and ideally through a successful exit. That's quite satisfying. Most of my clients are in the tech space. I'm an active member of and participant at TAO, so I think it's a great organization. Glad you could all be here today. Within that tech, larger tech sector, I definitely have a focus on software and SaaS companies. My work varies on a daily basis, doing not only the corporate work that I mentioned, but also tech transactions of all types, operating as outsourced GC for many of my clients who range from small to large multinational companies. So keeps things interesting. While I wish we're all in person today, I'm certainly happy to participate like this. Thanks.
Great. Thank you, Josh. And Rippy.
Hi, good morning, everyone. Happy to be here. Thanks to KBF and TAO for hosting me, letting me be part of the panel. I'm a managing director in the software investment banking group for Truist Securities, which is the investment banking business of Truist Financial Corporation, which was formed from the merger of two large Southeast regional firms, SunTrust and BB&T, which came together to form the sixth largest bank in the country. A little bit about my background. I spent 17 years at Pacific Crest Securities, which was a technology-only boutique banking firm actually based in Portland. Did a brief 2-year stint at Robert Baird and have been with Truist now for about 18 months. I focus exclusively on software transactions of all types, M&A, debt and equity financing, et cetera. And I'm pleased to be here.
Thank you, Andrew. Okay, I'm going to try and pull up a slide deck here, see if we can do this.
Good luck.
Yeah. Okay. Are you guys seeing it at this point? Let's do, oh no, hold on. There we go. Are you guys seeing my screen by chance? Looks like that. Okay. So what we're going to start with today is a couple slides on that are really not tech specific, but more M&A generally, and go just through some just general information stats from this year. So the number of deals in Q2 of 2020 dropped by 29% from the year earlier, and the value of those deals dropped by 79%. During Q3, the number of deals increased 24% from Q2, and the value increased by 7%. So there was generally a rebound across all sectors of M&A generally. But as you'll see in a few slides, it was more significant within the tech space. Based on a Deloitte survey that was done with 1,000 executives and private equity firms, more than 60% of US corporate executives and PE investors indicate they have a larger appetite for M&A activity since March of 2020. So even during this COVID period, it hasn't really damped down the appetite for M&A. In fact, it's increased it. And what we've seen in the market is that the interest has really shifted largely to domestic M&A with less emphasis on international M&A. Nearly half of corporate executives and PE investors indicate that they have an increased interest in alternatives to traditional M&A. In Q3, the investment community declared that buyouts are back, with PE and financial acquirers activity surging as a percentage of total M&A, meaning that PE, hedge funds, financial backers are doing a larger percentage of the total deals as opposed to your traditional strategic exits is what we're seeing at this point. And then special purpose acquisition companies, or so-called blank check companies, have amassed billions of dollars in collective buying power. I know our firm is seeing a lot of this. We had an IPO earlier this year in a SPAC transaction. We probably have 15 to 20 firm-wide right now that are queued up for the first half of 2021. You may probably have seen some of this in the paper. It's kind of a hot item where people are raising money and effectively doing kind of what used to be considered somewhat backdoor IPOs. They become much more popular this year. This next slide is where we start to focus on the tech industry specifically. The tech industry experienced a decade low performance in Q2 with only 35 billion worth of announced tech transactions. The tech industry announced a stunning 205 billion worth of tech transactions in Q3, almost 6 times higher than Q2. In fact, Q3 was the second highest quarterly level in nearly 2 decades. I saw a statistic that even over the very robust recent history of the last 3 years, Q3 was about 75% larger in terms of deal volume than we've been running over this period. And software continues to be the most active subsector in the technology space, accounting for 56% of the deal volume and 58% of the value. There was a significant backlog of unicorns waiting for IPOs as a result of COVID. And that's to some extent what we saw during Q2. Though that included Palantir, DoorDash, Robinhood, Databricks, Unity, Tanium, Snowflake. A number of those actually made it out. There's still a few of these that have not gone public yet. They're indicating most of them, they're looking at the first half of 2021. And I know that Andrew's been actually involved in at least one of these IPO transactions. We did have a very successful, and many of you I'm sure have seen this in the paper, Zoom Info, a local company based in Vancouver, Washington, completed a successful IPO in June of 2020. In Q3, there were 31 announced transactions in excess of 1 billion compared to 5 in Q2. So when people are looking at M&A, some of the top concerns that people are looking at managing in kind of in this new virtual environment we're dealing with COVID are listed here. And again, these came largely out of a large survey that Deloitte had done a couple months ago, but kind of as expected to some extent, cybersecurity threats, ability to build relationships with management teams, extended regulatory approvals, ability to assess workforce and talent levels, health and safety concerns, third-party transaction support slowdowns, and prolonged due diligence.
Hey, Peter, do you want to update the slides?
Oh, yes. Are you seeing the slides move forward?
I'm seeing just the first slide.
Okay, super.
Yeah, same here.
Okay.
Uh-oh.
Yeah, I honestly don't know. Are you guys not seeing my slides right now at all? You're seeing here. Oh, well, I apologize. I'm not able to make it work. Let me read off this last slide, honestly, and then I'm going to turn it over to the presenters or the panelists on our questions. And so, and the top concerns for post-transaction integration during this COVID period are technology integration, legal entity alignment, customer communication strategy, employee communication strategy, operating adoption, and corporate culture. I mean, I think what it kind of comes down to on both of the two lists of concerns that I just rattled off in terms of how you manage a transaction, as well as kind of how you deal with the post-transaction integration, really kind of come down to communication. Almost all of these are kind of things that are being driven by COVID, just simply because we aren't being able to communicate in person. But at this point, I will stop sharing because it's not working anyway. And we'll move on to the panelist questions. But before we do kind of dive directly into the M&A insights that they have, I'd like each of them to talk a little bit about the kind of the impact COVID has had on their business as well as their industry. And maybe we'll go ahead and start with Andrew.
Yeah, sure. So how has COVID impacted the investment banking business? Overall, I'd say the industry has held up rather well, while M&A volumes and fees are definitely down, as indicated by your statistics there, Peter. But it's really been made up by financing opportunities in both equity and debt capital markets, which have, roared back with a vengeance, particularly in software. Public market valuations for software businesses are pretty much at all-time highs right now. If you looked at forward sort of enterprise value to sales multiples or earnings multiples. So we've remained actually quite busy, and we've actually seen a number of very large technology deals occur. For example, the Snowflake IPO, which we were a part of and a book runner on. So I'd say in general, our activity has been different in terms of our business mix, definitely a little bit more focused on financing, but overall, things have remained relatively robust for us, just in a slightly different way.
Great, thank you, Andrew. Josh, can you talk about the impact on the legal field?
Yeah, and I guess, just as a starting point, it does occur to me that as bad as 2020 has been, can you imagine if this had happened 15 years ago or 20 years ago, prior to, the rollout of all these terrific, virtual technologies and Zoom meetings and VPN access to your workstation. So I think in one regard, we're a little bit lucky. When I think about that question, I guess I think about it in a couple of contexts. One is just as a business owner, like many of the business owners out there, Tonkon has 250 employees. And just like all of you, we've had to deal with, the disruption and challenges of just transforming the way we did business and implementing COVID plans and procedures to keep employees safe and to restructure our infrastructure internally, and also how we deliver services to clients. Luckily for us, we had invested in technologies and virtual work rules in the past, so it made it a little bit easier than some of my clients. But I can definitely relate to the challenges that businesses are just facing generally. As for the legal industry, I think it definitely varies by practice. It's certainly been easier for business transactional lawyers like me, as opposed to my litigator partners or other people doing non-business practices. I know the courts and other practice areas have been facing challenges that are much different from us, because for us, deals, as rarely get negotiated in person. And it's surprising how well we've all adapted to working remotely. Now, that said, there's still a lot of challenges. And here's what we've been focused on. First of all, is staying out in front of how COVID and all the other events of 2020 are impacting our clients, and how can we best support them. Certainly in Q2, there's a lot of time and effort spent helping our clients with CARES Act relief opportunities and PPP, Paycheck Protection Program loans. So that kept us busy. In Q3, as you mentioned, deal flows picked back up. And so we've stayed very active working those deals. And we're also trying to figure out how to stay connected with clients. I don't know about the rest of you. I personally like face-to-face interactions, and whereas Zoom meetings work, I think I get a lot more out of a face-to-face visit or visiting clients on site. And so we're continuing to try to figure out how to manage that, how to market. All of our marketing events have mostly been canceled. So we're working on that. And then, also internally, how do you maintain team cohesion? Yes, when I say this works, it does work. We're getting the job done. But, over the long term, I do worry about, whether or not we're all going to stay cohesive as a team, and how you train the younger attorneys. So we're still trying to figure it out. I don't know if we're ever going to go back to the way it was. I think we'll land in some sort of a hybrid place, but that's essentially how it's affected the legal industry from my perspective.
Right. Thank you, Josh. And Dirkson.
So my experience naturally is, I guess, a lot different than Andrew's in terms of how it impacted the aerospace industry. As I mentioned earlier, Loar Group, the business that I run and started, we make aerospace components for the aerospace industry. 70% of our sales, what I describe as, goes into commercial transport, which is, think of that as airplanes with 20 passengers or more. General aviation, 19 passengers or less, is about 10% of the business, and the balance is military. So COVID has impacted us across those various sectors a little bit differently. On the military side, we're seeing strong revenues, probably record sales in 2020 in that regard. And in terms of general aviation, it's amazing the rebound on the general aviation side of the business. Think of it as private jets, business jet aircrafts, etc. Flights are about 85% of what they were pre-COVID. So it's rebounded nicely. So on that side of the business, we're also seeing growth. Now, I did mention that commercial is 70% of our business. And I'll just say it this way. These two words, social and distancing, putting them together, I never had it in any of my downside cases. And let's just say I'm experiencing that on the commercial side of our business. Half of our commercial sales, what I've described as original equipment. So those are parts that go on, the original equipment manufacturer. Think of Boeing, Airbus, Embraer, etc. And the other half of our sales, we get in the aftermarket. So as long as planes are flying, we get revenues. On the aftermarket side of the business, we're seeing that rebound because Flights originally went from 100 to 5. Today we're around 40-45% of where we were pre-COVID. So the aftermarket side of the business, we're seeing improvements in revenues. On the OE side, there's going to be challenges because the ultimate customer, our airlines, are going to struggle now. I mean, those guys measure a good day by how much money they did not burn today. So they will have to strengthen their balance sheet in such a way they'll be able to afford the new aircraft. The good news for us, because overall we're still generating significant free cash flow, is primarily because of how we focus on acquiring these businesses. We're focused on accumulating capabilities that put us in a position where we are the sole provider of those parts. So 85% of our revenues, you can't go anywhere else on the planet to get those parts other than to come to us. So I believe this. I believe it'll take the aerospace industry a few years to recover, but it will, and it will return to its secular growth. So unlike Andrew, I do feel a little bit punched in the gut because of COVID.
Thank you, Dirkson. All right, on to our next question. What are the larger macro trends you are seeing emerge in M&A during this COVID period? Are you seeing differences in the types of transactions or opportunities? And Andrew, why don't you go first?
Yeah, I would say, probably the biggest difference we're seeing, particularly in M&A deals and processes, is actually in fact related to the process that we as an advisor would run and others would run as well. We're seeing a lot fewer kind of full auction processes where you take a business out and you market it to 100, 150 potential buyers. We're seeing far more owners of businesses, whether those be private equity firms, private owners, et cetera, large corporates. They're really more interested in running more limited processes with a smaller number of parties. Obviously it's far different running a business in the COVID environment, and running a sell side process is a huge distraction, particularly if it's a large process. So these limited processes have really come to the fore, and we're actually seeing quite a few kind of one-to-one negotiations take place. The other thing I would say we're seeing is, we are seeing more bespoke situations with more targeted outreach on the part of buyers. So these are situations where, maybe a buyer, whether it's a corporate or a private equity firm, knows a business, knows the management team, has met the management team in the past, feels good about them, and seeks them out and asks the question, would you be open to pursuing a transaction with us? They're more comfortable with that type of situation where they've already had a chance to maybe do some diligence on the management team, because obviously in today's world, you're really not doing a lot of in-person diligence, and it's hard to get to know teams just over Zoom. So in those instances where two businesses know one another, or a buyer knows a seller, or the seller knows a buyer, we're seeing many, many more of those kind of one-off type of situations. And I guess the other thing I would say as well is private equity has remained just incredibly, incredibly active. We haven't seen as many sort of changes in the types of transactions, although you mentioned previously, Peter, the SPAC process. So we are seeing more interest in those types of deals. In fact, we were on one transaction not too long ago that was a de-SPACing transaction for a business called Repay. And so that activity has certainly come to the fore.
Great. Thank you, Andrew. Josh?
I definitely agree with your initial summary, Peter, and Andrew's comments as well. I mean, we do our best to try to track trends internally, and then we of course rely on a lot of industry reporting. And the good news is tech, by and large, as compared to a lot of other industries, has handled COVID fairly well, right? And that of course it varies, but specifically software companies and my clients have done pretty well, and that's for a number of reasons. And I think for some of those reasons, I mean, tech deals have been prioritized. We certainly have seen an uptick in activity in Q3, not only on the M&A front, but with respect to, as I mentioned, I work with earlier stage companies, early stage financings, and everything has gotten back to what feels a little bit normal. We always have to be careful with that, but I definitely agree that for most of my, mid-market private clients, the PE private equity interest has been robust. And, as Andrew mentioned, they're of course very well funded, and it just seems that they've been sitting on their hands and are now looking for activity. And we've seen a lot of them, just reach out unsolicited to our companies and our clients and try to strike deals. And those deals, there's been a high interest in both platform and add-on deals. And, we've had some discussions about whether a particular acquisition falls in platform category or the add-on category, but we're sorting through those. Valuations have been probably the biggest challenge. Once there's interest, trying to land on a valuation both sides comfortable with, given all the uncertainty, has been something that we're certainly working on. Definitely fewer corporate buyers. I think Andrew mentioned this as well. I think many of those companies are probably busy looking internally and not externally, trying to handle their own COVID-related issues. So that's certainly a trend we're seeing. And then lastly, I'd just say, COVID's dominated 2020, but there's also been a big social justice movement. And we are seeing a little bit of increase in deals that are focused on ESG issues and employees and diversity. And so, that's of course good to see.
Right, thank you. And Dirkson.
Yeah, so like I said earlier, I've been doing this for 3 decades. So I've lived through, you name your favorite recession, most recent liquidity crisis in 08. And this time there is a lot of difference. I'm only going to mention 2, since there's been so many for us as we see it. Keep in mind the current business that I'm running. We've done 12 acquisitions, hoping to sign the 13th here in the next week or 2. But to get to those 13, I probably looked at over 400 businesses to acquire those 13. And I would tell you, prior to COVID, we were seeing businesses of all types and sizes across different sectors. Now, what I'm seeing is, I think, as both Andrew and Josh are alluding to, is more strategic, more clear targets that are coming out. I'm not seeing anything yet in the commercial side of the business. Again, 20 passengers or larger aircraft. Military, general aviation, we're seeing lots of those because, of course, what's a better time to sell a business of selling parts to the military than today versus commercial. The interesting thing is, and this is for the first time I'm seeing this, our end customers, think of them as the Boeing, the Airbus, etc., have significant concerns about their supply chain. So this time around, what I'm seeing is they're actually looking to partner with the companies that have strong balance sheets, who can get to the other side of COVID, who have niche capabilities that you can't find, most everywhere else on the planet, to make sure that those products that spec'd onto their aircraft, they will get on the other side. So I'm seeing a lot more hand-holding from the OE, the tier ones in our space, as opposed to the typical conversation of, can you lower your price by 30%? It's more, how can we help you make sure you're getting to the other side? So seeing a lot of those differences. And I guess the last thing I'll add, I'll agree with Josh. When we're involved in auctions, I'm seeing less large corporates chasing the businesses that we're looking at, because as he alluded to, they are inwardly focused on making sure they also get through to the other side, and their supply chain is strong.
Great, thank you, Dirkson. So now we'll move to kind of positive transaction experiences, and we'll start with Andrew. When you are working with a company looking for an exit, what are the attributes and intangibles that contribute to a successful exit?
Yeah, we as investment bankers tend to spend a lot of our time focused on the financial attributes of various businesses. And so we look for positive attributes that include, robust business models that are typically indicated by things like high gross margins, businesses that have either all or the vast majority of their revenue as recurring, businesses that are demonstrating top line growth. and either profitability or at least the ability to be profitable in the relative near term. So those are all things we focus on from a financial point of view that usually result in positive outcomes. You know, the intangibles that matter can include things like, you know, a focus on large market opportunities or on very successful niche markets where you're a leader in that market, where companies have some sort of a competitive advantage, whether it's from their technology or their sales motion or other characteristics, where they've got a great product and a solution, they've got happy customers, and management teams that frankly are very good and excel at running the business. These are all the things that we think about when we enter into a process with you know, either a buy side or a sell side client.
Great, thank you, Andrew. So Josh, for you, when a company is looking for an exit, what can you do to prepare for that from a legal perspective?
Yeah, well, I think you nailed it right on the head, that from a legal perspective, it's all about preparation, right? That's the real key to success and trying to ensure that you have a smooth transaction. And, you know, it's not typically even just months of prep, it's years, ideally. You know, that's my perfect world. I know we don't live in a perfect world, but, you know, once a term sheet's signed and the high level deal points and structure are negotiated, and there's obviously mutual interest, you know, that part's fairly straightforward. But once you dive into the diligence, specifically legal diligence and the legal negotiation, is when some issues can come out. And so, you know, the goal is to maximize your deal value, help ensure the smooth transaction, and that's all about preparation. So, you know, here's a few tips. You know, one is, as I mentioned, starting early is really, really crucial. I get it. I work with startups, and you know, money's tight and the legal budget is small, and everybody's distracted, and you know, that's a risky time for them to, you know, make mistakes that later can bite them, whether it's, you know, a corporate structure or issue, promising somebody an option on the back of a napkin, or not locking down their IP, or, you know, misclassifying employees as contractors. I mean, there's just a lot of gotchas. So, you know, starting early, you know, at the startup phase, yes, you got to prioritize, but, you know, work with the right partner. They'll help you prioritize so that those things don't bite you later. You know, number two, you know, work to get on the radar of potential acquirers early, right? Build relationships in your industry. I mean, quite often, you know, those end up being the routes to a successful acquisition. You know, preparing for diligence is just important. Maintaining good, organized digital files, utilizing an online data room, you know, planning ahead by, you know, compiling diligence items in advance. You know, your attorney, your accounting firm, your banker, whoever can help with that and give you a list of things that you will likely need to prepare for the buyer. And then it's all about building the right team. You know, not every sell side transaction, you know, includes an investment banker, but they can certainly help. And, you know, finding the right one that specializes for companies at your stage and within your industry is really important, along with, you know, finding a good accounting partner and getting your financial records in order early. And your legal team that helped you through, you know, your growth phase may not be the right team to help you through the M&A. So just making sure you got a right partner there. So absolutely, Peter, it's all about preparation.
Great, thank you. And now for Dirkson, when you are looking at acquisition opportunities, what are the attributes that make a target attractive to you?
Yeah, so there are definitely specific things that we look for, but before I address those, let me explain what we're trying to build, right? I think it was Andrew who said earlier, successful exit usually works easier when you're selling a business that has recurring revenues. And we take that very seriously. So we are looking to build a portfolio that is an annuity of recurring revenues, right? I mean, at the end of the day, I'm an economic beast like everyone else on this call, right? And we want to make sure that the business we're building, since we got the opportunity to start with a clean sheet of paper and only acquire businesses that we like, to build that annuity stream. And so far, so good. And I would be correct if I didn't address technology, even though I'm talking aerospace components, so folks understand one of those attributes that we definitely look for. So let me give you an example so you appreciate this. Every part on an airplane is spec'd on, and there's a drawing that exists that says you can only go to that person or these combinations of individuals to get that part. So one of the parts that we like in a plane is the brakes, recurring revenues. Every time a plane lands, you can hear the cash register rings, right? So we process those brakes. The brakes that we process are composite, carbon-based. And to get that qualified and to get your name on the sticker, that drawing, to be on that aircraft, one of the tests you have to go through to qualify is you have to take a plane. So think of a 737, an A320, whatever you like, 787, going down a runway, and it has to reject the takeoff right when it's about to take off. And then has to slam on those brakes. And here's how you pass the test, because everything burns. The passing of the test is the fire doesn't get through the fuselage and start to burn individuals. So imagine getting qualified for those braking systems. You don't get replaced because no one's going to give up an aircraft just to get a second source. So we look for businesses that have that level of IP, that are sole source, so that once the plane is in production and is flying, you have the recurring revenue and you have the stickiness, because there's nowhere else for anyone to go to get those parts because your name's on the drawing. One of the other things we look for is we look for diversifying our portfolio. The aerospace industry has been built around thousands of small manufacturers that are spec'd on in the manner I just described for decades past, because the engineers like the engineer across the street. And now that's the guy who's making those parts for the planes that you guys fly on. I will tell you, a lot of those guys are what we call mom and pop, and they have only one or two customers. So we look for those guys whereby we're adding those customers to our overall portfolio, whereby we can introduce the capabilities across the group to help drive top line synergies. But probably the most important thing, and I think Andrew alluded to this earlier also, is good people and good ideas, right? That is the greatest attribute you can get out of an acquisition. Those are the hardest things to come by. Capital, easy. Ideas and human talent, very difficult to come by. So those are just some of the things we look for and the reasons why, Peter.
Great. Thank you, Dirkson. That was great. So now we're going to talk about the other side, negative transaction experiences. And we'll start with you again, Andrew. When you've been involved in transactions that have gone sideways, what are the primary drivers that cause that to happen?
That's a loaded question because there are so many ways that deals can go wrong. It's hard to point to just one or two things. Frankly, one of the biggest challenges in transactions can be just managing different personalities on both sides of the fence. People can sometimes clash, and that can make things difficult. But typically, one of a couple handfuls of things tends to happen. For example, a company may miss its numbers during a process and miss their forecast, and causing the buyer to either walk away or to lower their price. There may be some unknown issue that wasn't previously disclosed that pops up in due diligence. Maybe there was a lawsuit filed or something like that against a CEO in the past, or maybe there was something that turns up in a background check. So there are just a lot of different things that can occur. I remember one transaction I worked on that almost blew up, but was finally successfully consummated. We discovered an IP issue in a small piece of code that the company had written that infringed on someone else's IP, but the client was able to mitigate it through eliminating that code. So, there are many other things that can go wrong, which is why it's very critical to have, good advisors, good lawyers like Josh, good accountants like KBF to assist in solving problems, hopefully before they even happen. You always want to know the bad things about your clients going into a process so that you've got ways to mitigate them before you actually enter into discussions.
Thank you, Andrew. And so Josh, I'll ask you the same question.
Yeah, I agree with all of that. Lots of reasons why deals go sideways, and going sideways can mean that it falls apart entirely, or it can just mean that it costs you a lot more, either in transaction expenses or in the purchase price. But it's all about surprises. You just don't want surprises. So, a couple examples I'll point out in addition to the ones Andrew mentioned is, just general failure to prep in the ways that we talked about earlier. Let's early stage software company incorporates a bunch of open source components without being aware of the types of licenses that they're subject to, and builds a whole product and a platform around that, and it becomes discovered later on. That can be a problem, and I've seen that as a problem. Failure to account for things that are outside your control, right? I mean, the buyer and the seller can control their own activities, but if you need regulatory approvals from third parties, or you need consents of strategic partners or landlords or banks, those things can throw a big monkey wrench into the deal. And then the last one I'll just point out is one that's come up recently, and it's applicable to Cobit, is around Ppp loans. People should just be aware that those can complicate deals. Everyone, gets those, or a lot of companies have gotten those loans, but buyers, when they learn buyers, when they learn that the seller has a loan, they're going to do some specific diligence around eligibility and the necessity of the loans and the use of funds, and making sure that you've properly recorded all that is important. And then ultimately the sellers want to obtain, forgiveness. And you may not be aware, but if you don't get forgiveness prior to the deal, that will likely require in the deal the consent of the lender, which is easy enough, but also potentially the SBA, which is not easy. And there are alternatives to that, including escrowing funds, et cetera. But just being aware that PPP issues are out there and need to be resolved as part of the transaction earlier rather than later is important.
Great, thank you, Josh. And so for you, Dirkson, as an executive who has done numerous acquisitions, have you ever been involved in an unsuccessful acquisition, and what made it unsuccessful?
I would be lying if I said I've never done an unsuccessful acquisition. I have, and what the challenge was culture. I think, as I mentioned earlier, one of the most important things is the human resource talent. So let me describe this business. When we acquired it, they would sell parts based on a piece parts basis. Let me explain what that means. It means that the machinists were getting paid for producing good parts. And so it was a firm fixed price for them. And they would work depending on how much parts they would produce and get paid for. Now, and they did a great job. They're strong machinists. It's the reason why I was interested in the business. They could make parts with a precision that I hadn't seen from others. The problem showed itself when the following happened, and then now you can appreciate why I was unsuccessful. I had a customer who called and said they had an aircraft on the ground and they needed certain parts produced over the weekend so they could have it first thing Monday morning. This was Friday afternoon. I called my guys at this particular business and said to them, this is the part we need. The machinist that made those parts literally says to me, I'm going camping this weekend. I'm not going to do this. Needless to say, when you can't meet commitments like that to your customers, it's just a matter of time before that business doesn't perform as you would like. I tried to pivot to a more traditional culture. That didn't work because the talented machinists who they were getting paid for the piece parts and were hiring people with less skill below them so they could pay them cheaply and keep as much of the profit as possible, they left. So we were stuck with a business that couldn't produce parts to the quality that our customers inevitably wanted. That tough lesson for us. But along the journey, there will always be unsuccessful ones. So culture, talent, very, very important.
Thank you, Dirkson. And as a follow-on, now that we know that you've been involved in unsuccessful acquisitions, what are two behaviors that, in hindsight, should have caused you to take pause, and why didn't you?
Yeah, clearly, I should have paid more attention to the culture. And I remember one thing I heard over and over again from the owner of the business. He kept saying, hey, this is going to be great for you. Once you acquire the business, I guarantee you these guys are not going to leave. If you're buying a business, someone keeps telling you that the folks that work there are not going to leave over and over and over again, pause. I clearly, looking back, realized that was a huge mistake on our part, not considering the culture and really listening to what you were being told. And I realize now that it was just our overconfidence that put us in that position, because I bought so many businesses and always found a way to make it work successfully, that overconfidence put us in that position where that particular acquisition did not work out. Lesson learned.
Great, thank you, Dirkson. So now we're going to move to due diligence. What has changed in the due diligence process during COVID? And Andrew, I'll start with you again.
Yeah, not as much has changed from an investment banking perspective as you might think. Much of our due diligence process was already either digital or telephonic. Over the last 15 years, most due diligence is done either electronically through online data rooms or sharing documents via email, hosting conference calls. Now there are more video calls, lots of electronic document exchange, lots of virtual meetings. But the biggest change has been in simply the lack of face-to-face meetings, which is, at this point, almost a practical impossibility. In most cases, there are no longer days-long management meetings in person for significant presentations like there used to be. And I think that's part of the reason why we're seeing maybe some more of these limited processes get run, because if somebody already knows a business and understands it well, they don't necessarily need a long 100-page presentation to know that they're interested in acquiring it. The other thing I would say, and I'd be interested in Josh's perspective on this, but there's also a significant amount of scrutiny around, ensuring certain things that can take place during COVID don't happen. So making sure that, for example, there's a business continuity plan in place, ensuring that, you've got the right security policies, ensuring that your data is secure. So that if your workforce does have to go remote, as we all are today, the business can easily accommodate that. So that's been a bigger area of scrutiny in the last, call it 8 or 9 months.
Thank you, Andrew. And Josh?
I agree. I mean, process-wise, from the legal standpoint, we've been sharing docs in virtual data rooms, and that's, corporate docs, commercial agreements, for a long time, so that hasn't really changed. I agree also that it's that face-to-face interaction that isn't happening, and that can be important to get comfortable on both sides. That from a seller standpoint, that this is the right partner, and those integration issues won't be insurmountable, and that has been a challenge. The biggest change that I've seen is just the areas of focus, and so to Andrew's point, yeah. Buyers now want to do diligence on all the COVID-related issues. From an employee standpoint, how is the company keeping everybody safe? Do they have a policy in place? What is the short and long-term, remote workforce rule or policy program going to look like? How are you maintaining security? All of those things that he mentioned, that clearly is an area of focus. There's others. It does seem like on the financial side, there's maybe a little bit, given the uncertainty, there's a little bit more focus on cash flow in addition to, just EBITDA numbers. I mentioned the Ppp loans. So buyers are definitely asking about that right away, because that's important. As our third-party approvals, regulatory approvals are taking much more time. And so that's something that's part of the diligence. Business plans and forecasts that may have been created a while ago, those are getting increased scrutiny. And in light of the uncertainty, buyers are asking about whether those are realistic. And so that seems like it's coming up along with, typical tax issues that are in flux and uncertain right now. So that's mostly the difference I'm seeing is around the areas of focus, not necessarily the process.
Great, thank you, Josh. And for you, Dirkson, maybe just change the question just a little bit and focus in a little bit on culture. I know you've driven that home a couple times today and talked about how important the culture of the companies, the management, the talent there. How are you dealing with that? That's a big item for you, and obviously you're not being able to sit in front of them and have the normal presentations. How are you dealing with that obstacle?
Yeah, I was actually going to say that what Andrew and Josh articulated were all the things that would be on my list of things that are different. Doing diligence, specifically SBA terms around the PPP loans. I agree with you, Josh. Challenges in that because that's new for everyone. But in terms of culture, especially since you're meeting management via Zoom as opposed to in person, it is very important. So one of the things that you do is you look at how they treated people during the pandemic. That says a lot, right? You have some businesses who have reacted quickly and said, 30% of my business is gone, 30% of the people in this building are now gone, right? You have businesses who have said, gotten their team together and said, guys, if we each take 15% pay cut and we just hold down the fort, all of us can get through this together. And you see that. I've seen folks pay their people's insurance for them, their contribution just to help people make ends meet. All right. So in terms of culture, it's interesting. You can get a good sense as to who is actually building a team for the long term by how they treat folks and who it's truly just a commercial exercise. And as I said earlier, that's important to us because especially since we plan to continue to build this business for, decades into the future, you want to have and build that team.
Great, thank you. So we'll probably have to keep this next round a little bit short so we can get a few Q&A questions, but just quickly, looking forward to 2021, what are each of you seeing? And maybe we'll start with Andrew.
Yeah, I think you'll see M&A deal flow steadily pick up and continue to accelerate, particularly as some of these hoped for vaccines get distributed and businesses hopefully get back to normal and people gain more confidence in just the broader economy. If debt capital remains inexpensive, which it is right now, equity valuations are still strong and the economy holds up, M&A should be just fine and come back to some normalized level. I don't see much that's going to dramatically change deal structures. And typically as M&A markets gain pace and accelerate, we may actually start to see more seller-friendly terms in deals, like, for example, having no escrow with just rep and warranty insurance to cover breaches and things of that nature. So I expect the next year to be actually pretty robust.
Josh?
I'll say I'm notoriously bad at predictions, so keep that in mind. But I agree with Andrew. I'm certainly optimistic. I think the rebound from Q2 to Q3 has been a good sign. But look, there's a lot of uncertainty out there still. How quickly will the vaccine come on the market, and will people take it, and will the market stay strong, and will there be another stimulus package, and what's the new administration gonna do to impact this industry, and what about tax changes? So I feel like there's a lot of uncertainty that we all still need to deal with. Those get managed directly and indirectly through deal structures and terms. I agree with what Andrew said. I'd also point out that we've seen some debates around working capital targets and whether historical numbers should be used or whether that needs to be updated. I mentioned the PPP issue. I think with uncertainty, a lot of times deals are structured to include earnouts and more commonly than otherwise. And then just the general legal terms like, you know, material adverse effect and force majeure clauses and reps and warranties generally are, you know, are all now colored by COVID and COVID risks. And so, you know, we're just seeing those sorts of terms and discussions and negotiations come up.
Thank you, Josh. And Dirkson?
So I agree with both Andrew and Josh. I do see as we go forward, M&A activity picks up in our industry. I don't think it gets back to, at least performance within the industry gets back to levels pre-2019 until there's a vaccine in place and you know, we get through the economic burden that we've put on folks. But I do expect it to pick up. We've mentioned the Ppp loans now here, I think in the last 3 questions. What I'm seeing is the Ppp loan threw a lifeline to some of those mom and pop companies that I referred to earlier. And some of them, we're talking about culture, actually reacted in a way where they didn't cut costs and are going to get challenged as we move into the spring. So I see a lot more of distressed acquisition opportunities in the aerospace industry as we move into 2021. I see folks using less leverage as we move forward because of the lack of visibility, especially in a space where visibility was one of the reasons why folks would invest in the aerospace industry. So folks will use less leverage. And I don't remember who mentioned it earlier about cash being king. As people do diligence going forward, cash will be king and queen. People are going to want businesses that generate free cash flow, and they're going to want to understand that better. So more M&A, less leverage, people being more selective around those targets, looking for strong annuities around cash flows.
Great, thank you, Dirkson. And so now I'll just cut to Q&A quickly. We probably only have a few more minutes to go here, and we're not going to be able to get to too many questions, but one that came in, and I'll let you guys decide who wants to take this, who has the best visibility. But one of the questions is, you're talking about the importance of post-deal integration to capture the expected value of a deal. Have you seen investment bank or PE firms bring integration playbooks and experienced deals as billable professional services post-deal? I've honestly not seen this. I don't know if any of you have seen.
I do know that private equity firms often do have integration plans. Investment banks don't typically get involved in providing those, and we certainly, you know, we're fee-based advisors, so we wouldn't get into something that was sort of more billable hour type of discussion. I suspect that that's probably something Dirkson could probably answer best.
Yeah, I'll chime in. Yes, I have seen that, and you can, you know, in all the 30 years I've been doing this, I'd say 70% of the time the businesses I've been running are owned by private equity. So I've seen all the playbooks. Some of the guys are very big sticklers on having their teams parachute in and help you run your business, right? I am seeing people focus on doing more of that, more operating partners getting involved, helping the businesses determining how they should get through COVID and what they should look like after. So yes, there is definitely more hand-holding is the way I describe it of that going into the future for sure.
Okay, great. And I think there's maybe one more question. Oh, here we go. And I think probably this one we kind of addressed earlier when we talked through the diligence. Hopefully that did answer this question. So I think at this point, I mean, we promised we'd keep it to an hour. I want to thank the panelists. I thought you guys did a great job. And I guess on behalf of TAO, we'd like to thank everyone for participating today. And hopefully you attend some of the upcoming events. And Skip, I'll turn it back to you if you want to close out here.
Fantastic. And thank you to Peter and the panelists for taking some time to share their insights with us today. A big thank you to KBF and also to Roth for their support for the series. And we'll be doing more of the finance community programming in 2021. So stay tuned for more on that front. And thank you finally to all of our attendees. I think that was a really great conversation and we got through a lot of the questions. So we've got a lot more to think about as we head into 2021, and hopefully this provided some insight to help folks navigate. Thank you, everyone. Hope you have a great rest of your day.
You too.
Thanks, y'all.
Yep.